Hello, all of you. I hope you all are doing good. Today, we are going to do the revision of Accounting Standard 19, that is lease. Okay. So, generally, students find it difficult. Let me tell you honestly, this is not at all a difficult accounting standard. Just you have to listen me carefully. So, there are so many things that we are going to discuss: the meaning of lease, the type of lease, the finance lease, the operating lease, and there are so many definitions in Accounting Standard 19 and how to do the accounting in the books of lessor and lessee. There is a concept of sale and lease back and the manufacturer lessor. So let's first start with the concept. What do you mean by the lease that here? Lease basically means that one person is agreeing to give the right to use the asset to another person, on obviously in return he will get certain amount from them. So what happens? Suppose there is a person called Mr. A. So what Mr. A is doing that here, he is giving his asset to use it to another person, and for that he will get something in what? Return. So what we call them lease. Okay, if you see the definition here, what it says that here now, an agreement where the lessor owner transfer the right to use an asset to the lessee in exchange for payment over agreed period. So here there is an agreement happened. One person who is the owner. Who is the owner of the asset? Lessor. Who is the owner of the asset? Lessor. And to whom he is giving to use the asset, what we call them? We call them lessee. So there are two parties here, the lessor who is the owner of the asset, and the other party is what? The lessee who is going to use the asset, and in return he will give the amount to him. Okay, so we call them lease. Now please understand this point here. As you can see that there are two parties here, lessor and lessee, correct? It means we have to learn how to do the accounting by these two parties, lessor and lessee. So we'll see that how they will do the accounting in their books of account. But before we come to the point how they will do the accounting in their books of account, it is important for us to understand there are two types of lease, operating lease and the finance lease. Why it is important to understand the meaning of operating and finance lease? Because the type, how to do the accounting depends on the type of lease it is. If it is the operating lease, the treatment will be different. If it is the finance lease, the treatment will be different. So it means that here, the four scenario is going to create here. How many scenario? You can see the fourth scenario. If I say that here now, when I talk about the lease that here, okay, now, when I talk about the lease that here now, the lease, it can be a operating lease, or you can say finance lease, okay, or operating lease. Now, in both of them, how many parties are there? Two parties, lessor and lessee, okay, lessor and lessee. Lessor and lessee. So it means that before we come to the accounting part, how they are going to do the accounting in their books of account, it is important for us to understand that here, what do you mean by finance lease and what do you mean by operating lease. Okay, now we'll discuss what do you mean by finance lease. So it says that here now, if the finance lease is transfer substantially all risk and reward. So here, the lessor transferring almost all the risk and reward of the asset to ownership. So how we'll find it out that here? So basically in accounting standard 19, they give us some parameters to see that if any of those parameters fulfill, so we are going to call them a finance lease. So we'll assume that all risk and reward has been transferred. So they say indicator of the finance lease AS19 outlines 8 parameters to determine of the finance lease. First, out of 8 parameters, first I am discussing with the 5 parameters. And then I will discuss with the remaining 3. What is the difference between both of them? I will tell you. But this is the first 5 parameters. This is deterministic condition. If any a condition is met, it will be classified as finance lease. So I am going to discuss with you 5 conditions. If any of those fulfill that, we are going to call them what? A finance lease. First, ownership transfer. They say the lease transfer the ownership of the asset to the lessee by the lease terms. So it is mentioned the contract at the end of the lease term, the asset will be transferred to the lessee. So we are going to call them the finance lease. Okay. Second, purchase option. Lessee has an option to purchase the asset at a price which is significantly lower than its fair value at the option exercise date with a reasonable certainty that the option will be exercised. What is saying that now? Let's take an example so it will be easy for you. Mr. A leases a car for 5 years with an option to buy it at rupees 20,000 while the expected market value is rupees 5 lakh. What happens? Suppose I am lessor, you are lessee. I am giving an asset that year. I am telling you that okay, I am giving you an option. At the end of the 5th year, you can purchase this car, and I'm offering you only 20,000, and it is expected the market value at that time. Okay, after 5 years, it is expected that the market value will be rupees expected rupees 2 lakh. So I am offering you just at 220,000. So most probably you will purchase the car. After 5 years, most probably you will purchase the car because at that time it is expected the market value will be 2 lakh. And I am offering at what I am offering at what price here is 20,000. So most probably we are going to purchase the car. So we are going to call them the finance lease. Now third, major part of economic life. The lease term covers a major part of the asset's economic life even without transferring the asset. Now, what happened that now it is not necessary to call it a finance lease. The asset should be sold at the end of the life of the asset. It is not necessary. Okay. They say if the major part of the economic life of the asset is used by the lessee, we are going to call them the finance lease. So they say XYZ leases a property for 32 years with an expected economic life how much? 40 years. So out of 40 years, it is expected that the lessee is going to use it for 32 years. Then major part of the economic life is going to be used by the lessee. We are going to call them the finance lease. Then they say the present value condition at lease inception. And one more thing that they have not defined the major part. Major part generally says 60-70% more than that. So we are going to call them the finance lease. Now it says that at lease inception. Inception means at the starting of the agreement. Okay. At lease inception, the present value of the minimum lease payment at least substantially or all of the fair value of the lease asset. What does it mean that here? They say here that here now at the inception that now, okay. Here what they say is that here now at the inception, here I am saying inception means at the starting that here now the present value. Okay, they say the present value of minimum lease payment. So present value of minimum lease payment. Now the question will come in your mind, what do you mean by minimum lease payment? That I will discuss with you. There are so many definitions that I am going to discuss with you. One of them will come the minimum lease payment. But understand time being, if the present value of minimum lease payment is substantially equal to fair value, then we are to fair value of the asset on the date of inception, means starting of the agreement. Okay. Here on these date, if the present value of minimum lease payment, not necessarily exactly the equal, more than 90%, you can say substantially if it is equal that here now. So we are going to go of the fair value of the asset on that date, we are going to call them the finance lease. Now what is minimum lease payment? We will discuss. Now here, the last one they say, lease asset is of a specialized nature, usable only by the lessee without major modification. Certainly we manufacture or we give the asset to the lessee, which is specifically modified, okay, as per the requirement of the lessee. They say PQR leases ambulance, okay, ambulance is designed exclusively for it. So we modify the ambulance exclusively for some to use by the lessee. So we also call them the finance lease. Yeah. Now we discuss about these 5 parameters. If anything happen out of these 5 conditions, we have to call them what? The finance lease. Now what happened? There are 3 more parameters, but it is not necessary in these 3 parameters that we are going to call them as a finance lease. It might be a finance lease that is. So they say suggestive condition, 3 parameters we are discussing, even if that here now all the conditions are met, it does not necessarily imply that it's a finance lease. It is not necessary. Even though all the conditions fulfill of these 3 parameters, we cannot 100% tell it's a finance lease, but it might be a finance lease. So they say here, first is the cancellation impact. They say lessee can cancel the lease with the lessor's cancellation losses borne by the lessee. They say, okay, lessee, if you want, you can cancel the lease, but if any losses happen to the lessor, it is going to be borne by, it is going to be bear by the lessee. For example, that a lease term is for 5 years. The lessee might cancel the contract anytime, but whatever the rent for the remaining period that year. Okay, for example, lease term is 5 years, he can cancel in the 2 years, but for the remaining period, if the loss bear by the lessor, then it has to be bear. I mean, if loss happened to the lessor, it has to be bear by the lessee. Okay, any loss of the lessor related to these assets, it should be borne by the lessee. So it's an indicator that most probably he will not cancel the lease, and they say it might be a finance lease. Okay, then they say residual value, gain or loss. They say gain or losses from the fluctuation of the residual value accrue to the lessee. So if any fluctuation in the residual value, what is the value at the end of the life of the asset? If there is a gain or losses from the fluctuation, if happen, it is going to be bear by the loss, or the gain is going to bear by the lessee, then they say it might be finance lease. And last is the secondary period at a lower rents. For example, the lease term is for the 10 years, but I say I will offer you more additional 5 years that year, and the rent I'm going to offer those additional 5 will be much lower than the market value that year. Okay, so most probably you are going to extend the lease term, and they say these might be an indicator that it's a finance lease. But here in the above these 5 conditions, if any of those fulfill, we are going to call them the finance lease. Now we discuss about when it can be finance lease. Now I'm talking with you when it can be operating lease. Operating is only transfer the right to use an asset, not all risk and reward. They say to make it simple that here, if it is not a finance lease, we are going to call them the operating lease. So they say here, no transfer of substantially all risk and reward of what here? Ownership that here. Okay, so what is going to happen now? No transfer of what? Substantially risk and reward. So there is no transfer of the almost all the risk and reward of the ownership. And to make it simple, if it is not a finance lease, anything not happen out of the parameters that we have discussed here, we are going to call them the operating lease. Now what happened before we come how to do the accounting in the books of the lessor and lessee in case of a finance lease and operating lease, it is very important for us to understand that there are so many definitions. So in these page, I am to discuss with you the so many definitions. Just you have to listen me carefully. Okay, no need to mug up the thing. Just listen carefully. First, they say the lease term that is. Lease term includes a non-cancelable period and any additional period where the lessee is reasonably certain to exercise the lease option with or without further the payment. What is going to happen now here? The lease term basically to simplify it, it says that here, suppose is the lease term is for the 6 years. Okay, but we say that we call them primary period, and we say the 4 years. If you want, you can take it on further 4 years that year, and most probably the rent will be the lower than with or without the rent. If the rent will be lower that as per the market, so most probably the lessee is going to utilize that. The lease term will not be 6 years; it will be considered at 10 years. Okay, not so important. Okay, it will be considered as 10 years that year. Okay. When it is reasonably certain that you are going to exercise this a further period also. So 6 plus 4, it is going to call as the lease term. Now, there are so many definitions I want to discuss with you. Minimum lease payment. Okay, then here the gross investment, unearned finance income, and net investment. So basically the 4 thing we are discussing now. What does it mean that here? Okay, so first they said a minimum lease payment that here. What do you mean by minimum lease payment? It depends from the point of view of the lessor we are talking, or from the lessee's point of view. Okay, but this table will help you to understand the concept that here. First, they say if the payment over the lease term by the lessee. Obviously, we have given the asset to the lessee. He is going to give us the payment over the period of the lease term. So is it a part of the minimum lease payment? Yes, in both the cases. Okay. Now, they say add any residual which is guaranteed. Any residual value which is guaranteed. Who guaranteed? Yeah, by the lessee. If suppose lessee say after the 5 years, this much is the residual value of the asset that he will give us to the lessor. If it is guaranteed by the lessee, okay, this is also part of the minimum lease payment. If not by the lessee, on behalf of the lessee by someone, for example, the lessee is a subsidiary company, on behalf of subsidiary company, holding company is giving an assurance that here now. So that is also called as what? That is also part of the minimum lease payment. But not if it is not guaranteed. First of all, it's a residual value. It is not guaranteed by the lessee or on behalf of the lessee, but it is guaranteed by independent third party, not by the lessee, not on behalf of the lessee, by third party. Then that is a part of the minimum lease payment only when we talk about the lessor's point of view, not from the lessee's point of view. Why? Because this amount is not going to be paid by the lessee in this case, or not on behalf of the lessee by anyone that year. So why it should be the minimum lease payment from the lessee's point of view? That's why in this case that here, if any residual value which is guaranteed by independent third party, that is going to be received by the lessor. So it is a part of the minimum lease payment from the lessor's point of view. But it is not going to be paid by the lessee. So it is not a part of the minimum lease payment from the lessee's point of view. Okay. So we discussed about the minimum lease payment. What is going to cover in minimum lease payment? That the payment over the lease term by the lessee that year, any payment which is going to be paid by the lessee, or any guaranteed residual value by the lessee or on behalf of the lessee or by the independent third party. But if it is independent third party, that is not a part of the minimum lease payment from the lessee's point of view. Okay. Now whatever amount come, we call them the first. Whatever amount come first, we call them the minimum the lease payment. What we call them? We call them minimum lease payment. Okay. Now the second part is, okay, we call them minimum the lease payment. Now there are certain notes on it. Let me read those notes as well. That here, what it says that here in point number A, it says that here now minimum lease payment excludes certain thing, does not cover in minimum lease payment. Exclude, what it exclude that here now? A contingent rent. Contingent rent, it is not fixed. It depends on some uncertain event. For example, depend on the sales. We will give the 1% like that. The cost of services or taxes if it is to be paid by or reimbursed to the lessor. Okay. So they say taxes, cost for service like annual maintenance charges, okay, or contingent rent, for example, the 1% of sale. This is not a part of the minimum lease payment. Okay. So we discuss about what to mean by minimum lease payment. Now understand this. In these minimum lease payment that here now, here we talk about only the guaranteed residual value. What do you mean by guaranteed? Which is guaranteed by lessee or on behalf of the lessee or by an independent third party. For example, they guaranteed 10,000 rupees. But I believe that here the residual value after 5 years, it should not be 10,000. It might be, I believe that it will be 12,000. So how much is guaranteed? I believe that the residual value will be 12,000, but how much is guaranteed? Only 10,000. So remaining 2 will be called unguaranteed residual value. What we are going to call them, that we are going to call them as what? The unguaranteed residual value. So whatever amount which is guaranteed by them, we are going to call them the guaranteed residual value. Whatever amount which is not guaranteed by them, we are going to call them unguaranteed residual value. Now listen carefully. Here, unguaranteed residual value is not a part of the minimum lease payment. Minimum lease payment, we discuss about the payment which is going to be paid by the lessee or the guaranteed residual value. But here, when I talk about unguaranteed residual value, means this is the part of the asset which is not guaranteed, that, and that is not a part of the minimum lease payment. So when I add the unguaranteed residual value that here now, so what we call them the gross investment. The second term that you have learned here, what does it mean? The gross investment. Okay. So in the minimum lease payment, when we add the unguaranteed residual value, we call them what? The gross payment. Okay, gross investment. But remember that now, when we talk about the gross investment, that is, the lessee is giving us the payment that here. Okay, so they are giving us the payment. They are not giving us he's not giving us the payment today. He is going to pay us over a period of 5 years. For example, the 5 years. So he is going to pay us for the next 5 years. Suppose he is going to pay us for the next 5 years that year. But there is interest component in that. So when we talk about this gross investment or the minimum lease payment, whatever payment is paying by the lessee, there is an interest component in that. So what is going to happen if from this gross investment that here now, if we deduct the unearned is nothing but a interest component in that payment. Okay, finance income. Okay, if we deduct from that here, then we will get what we'll get? We will get a net investment. Then we will get a net investment in what? The lease that here. You got the point that here now? Is okay, net investment in what? The lease that here. So they say here now is the minimum lease payment. Okay, in the minimum lease payment, we are going to add unguaranteed residual value. We are going to add what? Unguaranteed residual value. What we'll get? We'll get a gross investment. In that gross investment, we'll deduct the unearned finance income that here. What will get? The net investment. So remember these 4 things that here. What is going to cover in the minimum lease payment? The payment which is made by the lessee and the guaranteed residual value, and here we will add that is the minimum lease payment. Then we'll add unguaranteed residual value. You will find a gross investment. In that, if you deduct the interest component, you will find a net investment that year. So to make it simple, we can say the net investment is nothing but the present value of the gross investment. Simple to say. Okay, because you are deducting the interest component. So present value is nothing but a net investment in lease, that is nothing but a present value of the gross investment. Okay. So can I say that here unearned finance income is, or you can say that here is the gross investment minus net investment is the income, the finance income. This is what they are saying. Gross minus present value of the gross investment or the net investment. That is what? The finance income. Now, what do you mean by contingent rent? Variable portion based on the factors other than time. For example, certain percentage of the sales they will give in the form of rent. Economic life, the period or total unit for which the asset is expected to be usable by one or more user. But useful life is the period or total units for life which the asset is expected to be used by the lessee. So economic life, basically total life of the asset. Useful life of the asset which is expected to be used by the lessee. Okay. So it says that economic life is always longer than, obviously the life of the asset might be 10 years, but it is using by the lessee, for example, 8 years. So 8 years is the useful life for the lessee, but economic life is what? 10 years. So this is a useful life, depreciable life, time over which the depreciation is charged, and the economic life, the total time the asset remains capable of what? Generating benefits. Obviously, if it is used by the lessee for 8 years, he is going to charge the depreciation for 8 years. In economic life is the total life, the asset that it is capable that year to generate what? Some benefit. Okay. Now what is the residual value? These are not so relevant from the examination point of view. Only this table is important from the examination point of view. Okay. Now it says that here now, residual value is that here what is the expected sale value at the life of the asset. Okay, now non-cancelable lease. A non-cancelable lease is a lease that is cancelable. When it is cancelable? Only when upon the occurrence of some remote contingency, suppose the death of the lessee, okay, or upon with the permission of the lessor. If lessor permitted, okay, cancel the lease, then we call them and only in that condition it is cancelled. If the lessee enters into a new lease for the same or an equivalent asset with the same lessor that year. So they say with the same type of, I'm going to say new lease, they are making new contract of the lease or the equivalent, or for the same asset or for the equivalent asset. So maybe previous one can be cancelled. And they say upon payment by the lessee here, an additional amount as such that at inception continuation of the lessee is reasonably what? Be certain that here. So they say that upon payment by the lessee, additional amount that here. that at the inception that year, continuation of the lease is what? A reasonably certain is that year. Okay. Now what is going to happen? I mean to say initially it is continuation is reasonably certain. He is going to use it for the whole of the life of the asset that year. And whatever the terms that we have decided initially. Now honestly here, what is relevant for from examination point of view, these four terms, which is important, that is going to use when we talk about the accounting as well. Now the main parts come, we'll discuss about that, how to do the accounting in the books of lessor and lessee. So accounting of finance lease. But before we discuss about this accounting, remember one thing that here now, okay? When we talk about the lease that here, okay? When we talk about the lease that, how many types of lease that here? Two. The finance lease and operating lease, okay? Finance lease and operating lease. So let me write it down that here now. Finance lease. And we have here operating lease. Okay, finance lease and operating lease that. And these finance lease is further divided. How many parties that we have? Two parties that we have. Okay. So lessor and lessee. So lessor and lessee. Here also lessor and lessee. So now we'll discuss how to do the accounting in the books. So first we'll discuss about how we are going to do the accounting when we talk about the finance lease. Okay, finance lease, first party is that now is the lessor. Now understand this here. So in case of a finance lease that here, the asset is de-recognized. Now understand, when we talk about the finance lease, what is this finance lease? That the almost all risk and substantially all risk and reward has been transferred to the lessee. If the risk and reward has been transferred to the lessee, what is going to happen that now? The lessor has to de-recognize, remove the asset from the books of account in case of a finance lease. It's like a sale, but it is not actual sale, but I'm saying that. So they have to remove the asset from their books of account. So what entry is de-recognized from the lessor's book and it is going to be recognized by the lessee. So what lessor will do? Lessor will remove from their books of account and lessee will recognize. Recognize means to record. De-recognize means to remove from the books of account. So lessor, even the owner of the asset is lessor. But if it is a finance lease, AS19 says that they have to de-recognize, remove from the books of account. So what entry is going to pass here? Now understand this here. In the books of lessor, we are talking about finance lease that here. So they say lease receivable account will be debited to property, plant and equipment. That asset account should be credited. But remember, at what price he is going to record? AS19 says recognize the net investment in lease. What is net investment in lease? This is, you can say the present value of gross investment. Okay. At these value they are going to recognize that here. There is a gross investment minus the interest income. So they say, or you can say that because the gross, there is no interest component on that, or you can say the present value of the minimum lease payment or the unguaranteed residual value, or you can say the same thing, the present value of the gross investment. Okay. Then what happened? They have removed the asset from their books of account. They have removed the asset from their books of account that here. Okay. Now second entry, I will come to in the books of lessee later on, but they say here, if now the interest will accrue because we recorded the present value. So interest will accrue, it is receivable from the lessee. So lease receivable account will be debited, increase in asset should be debited to finance income, that is income. Now they say recognize over the lease term. They have mentioned something in note. I will go to those notes. Okay. Then first is we de-recognize the asset from the books of account. Then second entry is we recognize the interest income and then we'll receive the amount from the lessee. We have to pass the entry. Cash or bank account should be debited. This no B here. Okay. Cash or bank account should be debited and lease receivable will be the credited here. You got the point? There is no depreciation here. Why there is no depreciation in the books of lessor? Because you have already removed the asset from their books of account. Now, how the lessee will do the accounting in their books of account? So they are going to recognize the asset. So he will record PP account will be debited to lessor account because he is liable to pay to the lessor. Okay. Now, at what price? The AS19 say here lessee is going to recognize the asset in their books of account at a lower of the fair value of the asset at the inception of the lease, or present value of the minimum, the lease payment that here. Okay. So what those notes mentioned there, I will come to what is minimum lease payment calculation. I will come to that. But it says the lower of the fair value of the asset or present value of the minimum lease payment. Now interest is an expense for the lessee. So here finance charges will be debited. He is liable to pay to the lessor. Increase in liability should be credited. Now when he will pay to the lessor, so lessor account will be debited because decrease in liability, or cash or bank account will be credited. To bank account will be credited here. Okay. But as it is recognized in the books of lessee, so he is going to charge the depreciation as per AS10. So depreciation account will be debited, property, plant and equipment account will be credited. Now how to calculate the present value? This is the one table is given there. So whatever here that they mentioned the question that here. So minimum lease payment that here now we will multiply with the discounting present value factor, that will get the present value of the minimum lease payment and the total will come here. So basically when we talk about the minimum lease payment, what is minimum lease payment? Guaranteed residual value, and the payment is paying by the lessee over the period of time. But the present value of minimum lease payment, because we are recognized here what at the present value that here, okay, here like the present value of the minimum lease payment. So how to calculate the present value that here? Multiply by the present value, the factor that here, that they will give in the question that here. Okay, now second point. What second point say? They're talking about the calculation of the interest, because here we recorded the present value, okay, of the minimum lease payment. But how we do the calculation of this interest they're talking about, like here and here they're talking the interest that here. Okay, so interest is that here opening balance of the liability multiply by with the rate of interest that is interest amount. So this is what the interest amount, that whatever the outstanding amount of that the lease liability we have to multiply with the rate of interest. And then here if any minimum lease payment, if we write it down that here now, so what is the principal component? This, because this minimum lease payment, when we do that, I'm not talking about the present value, I'm just saying the minimum lease payment. It contains both that here interest principal amount plus the interest amount that here. I'm not saying present value, I'm just saying minimum lease payment. So if I say in this, if I deduct the interest component from these here, what is going to happen? I will find the principal component that here, and the closing balance will be opening minus that here the principal component that we have paid, remaining with the closing, then it will come as the opening balance. Okay, for example that here opening, suppose let's say that is 10,000, 10% interest that will come here 1,000. Okay, suppose the minimum lease payment, let's say that here is the let's say 4,000 that here. Now what is the principal principal component? I will say I paid the 4,000, interest component in that is 1,000, which is point number the 3 is mentioned. So how much the principal component that we have paid? 3,000. So I will say 10,000 minus 3,000, that will come here how much? 7,000. Or you can say opening was a 10 plus the 4, or you can say interest component was how much? Sorry, I have written it 10,000, is 1,000 here. Interest component is how much? 1,000, 11,000. We have paid minus 4,000, so that will come here as what? The closing balance will come 7,000. Okay, now we'll discuss how to do the accounting in case of an operating lease. In case of an operating lease, risk and reward not transfer, so no need to de-recognize. It still will appear as an asset in the books of the lessor only. So what is the first? At the beginning of the lease, present the asset under the operating lease as property, plant and equipment. Under the PP, it will mention that the given on the what lease that here, but it is not going to recognize as an asset by the lessee. But when you will receive the rent, it is like a rental income that here. Okay, so bank account will be debited, or lease rental and lease rental will be credited, because it is income for them. But it's a concept of the lease equalization. I will come to that. It is mentioned in the note near below this note. I will discuss there. Okay, but it is an income for the lessor, expense for the lessee. So lease rent account will be debited, bank account will be credited. Now you will ask me, sir, what is this lease equalization? I will explain in that here. Okay, but for one party it is income, for another party it is an expense. Now, as it is recorded as an asset in the books of lessor only, he is going to charge the depreciation. So here no, this is not entry of depreciation. Sorry, transfer lease rent to P&L. Obviously, this rental is an income for you. He is going to transfer to P&L account, nominal account. So lease rental will be debited, P&L will be credited, and he is going to charge the depreciation because asset is appearing in the books of lessor only. So that's why it just cut this point here. Okay. Now here it is an expense for the lessee. He will transfer the lease rent to the P&L. So P&L account debit lease rent, and depreciation is not applicable in the books of lessee because he has not recorded it as an asset in their books of account. But what they say, now we'll discuss about what they say about the lease rental. Okay, now listen carefully. Lease rental, they say, recognized as an income and expenses that are in the profit and loss account on a straight line basis. So they are recognized as an income or expenses that are in the P&L account on a straight line the basis over the lease term, unless another systematic basis is more appropriate. So they say whatever rental is getting recognized on the basis of SLM basis, unless and until another systematic is more appropriate. What is another systematic that here which is more appropriate that year? I mean to say, if they are not using in the same pattern, if constantly I'm using the asset, the best way to recognize that on a SLM basis. But if I am not using in the same pattern, so you may go for some other option, like the output of the asset is not the same. Something I have taken on lease, the output is not a constant over the period of time. So I may recognize in these income and expense in the books of in a different way, different proportion. Now we'll discuss that. So see what are another systematic basis. So when they say another systematic basis, generally we are going to recognize that in the books of as an income or expense. Whatever for one party it is income, for another party it is an expense. Okay. But in another systematic way, so what is another systematic way? Step number 1, we'll solve a question on it as well. That okay, calculate how much annual lease rental for the lease period as per the information given in the question. Step number 2, they calculate the lease rental to be recognized, allocate lease rental for the period in the ratio of output. So they will give you the output. For example, first year the unit is going to manufacture by that machinery like 10,000, then 20, 30. So in the ratio of 1:2:3 like that. The total lease rental for the period divided by total output and multiply the output of that period in proportion, basically in the proportion of output they recognize it. Okay, let's take an example that here. Okay, they say here, now the 3-year operating lease with the estimated output cost of the machine rupees 5 lakh, life of the machinery is 10 years, depreciation they charge unnecessary. Okay, so year 1 the unit is 10,000, then 20,000 and then 30,000. Okay, so what is the step number 1? This is in step number 1 we have to calculate the annual lease rental as per the information given. Suppose they give you the information that is 25,000 first year rental, 45 second year, third year 50. So if we do the total, that is coming 1,20,000. So step number 1, what is the total annual lease rental for the 3 years as given in question? That is coming 1,20,000. Okay. Then they say recognize on the basis of output. Okay. So step number 2 that here. Okay. If I say that here 1,20,000. Okay. 1,20,000 that here. Now this is for the, just give me a minute. Okay. First year, second year and the third year. So 1,20,000 is the total leases. Okay, this is for how much here? 1,20,000 for how many units? 80,000 units. 80,000. How much will be for the 10,000? How much will be for the 10,000? So 1,20,000 divided by 80 multiplied by 10, that is coming how much? 15,000. Okay. How much for the second year? 1,20,000 divided by 80 multiplied by how much for the second year? 20. So multiply by 20, that will come 30,000 here. So 1,20,000 divided by 80 multiplied by third year 50 multiplied by 50. 1,20,000 divided by 80 multiplied by 50, that is coming how much here? 75,000. Okay. If we do the total, that will come here 1,20,000, but proportion change it. Understand? First year that here, how much is going to lessor receive the amount that here now? He is going to receive the amount 25. But how much is going to recognize as an income? 15. So he will debit the bank account by 25 because he received 25. Okay. Now he will recognize only 15 as an income. So to rental income will be the 15. Remaining 10 we are going to transfer to account. We call them the lease equalization account. I will explain you what is the lease equalization account. That will go 10,000. Okay. Now these lease rental will go to, this rent is an expense, it will go to P&L. So lease rental, sorry, not expense, income. Is it an income? It will also go to P&L. So lease rental account will be debited and P&L will be credited. And as it's the operating lease, depreciation is going to charge by the lessor only. So depreciation account debit to PP account. Now what happened? When we talk about, let me explain it from the lessor point of view first that here. Okay. I will come to how the lessor is going to pass the entry. They have here, it is given only for the first year. Let me go for the second year only. So how much balance I have a lease equalization, lease equalization, how much balance I have a lease equalization that here now? In my lease equalization that here, we have a balance of how much here is the 10,000. Okay. Now when we come to the second year again, here the lease rental is going to receive 45. But how much will be recognized? 30. So next year he will pass entry. Bank account will be debited here is by the 30,000. No, not 30. He's going to receive the 45, but he will recognize 30. Okay, 45. To lease rental account is how much here? 30. And to lease equalization account, how much is the balancing here? 15. So if I talk about the lease equalization that is account, first year we credited by 10,000. So we credited here by 10,000. Second year we credited by how much here? 15,000. So second year we credited by 15,000. Now we come to third year now. When we come to third year that year now, it is mentioned we have to receive 50,000 that year. But how much will recognize? 75. So what entry will pass? We are going to pass entry bank account will be debited. We receive only how much? 50,000 that year now. But I am to recognize these rental income. Okay, lease rental income that year. We are going to recognize how much is 75,000. So how much we receive that year? We receive 50,000 that year now. How much lease rental will be recognized? 75. So what about this 25,000 that year? That will adjust again the lease equalization account. Lease equalization. We have a balance of how much here? 25. So we are going to debit to lease equalization account. So it will be debited by a 25,000 and it will get closed. So basically lease equalization is the difference between the how much rent we have received and how much is going to recognize. That is the difference. Okay. But ultimately the total rental we are going to receive 1,20,000 and the total rental we are going to recognize is also 1,20,000, but not in the same proportion. Okay. The difference in the difference between the how much is received and how much is recognized every year, that will transfer to dividend, not dividend, the lease equalization. Okay. Because there is one more account, dividend equalization. Anyway, lease equalization account. Okay. So that will get cancelled. Okay, so here we credit it by 10, then we credit it by 15, and then here we are to debit it by 25. Okay, done. Now here, okay, now from the lessee's point of view, it is an expense for he paid 25, will credit by 25. The opposite of that, what the lessor has done that here. So he will debit to lease rental, it will go to P&L, this 10 will go to lease equalization account. Okay, same for the second year, third year it will get cancelled. Now there is a concept of the sale and lease back that here now. So what I will do that here now, before I come to the point of sale and lease back, what we'll do that we'll do certain the practice here. We will cover the question from the super 100 questions. So I will come to the point of this sale and lease back. One concept I will discuss with you that here in detail, and then here I will discuss with you the what is manufacturer lessor also that here. Okay. Now come to this super 100 question number 61. The question number 61, what it says, classify the following into either whether it's an operating lease or the finance lease. We have to find it out that. They say lessee has the option to purchase the asset at lower than the fair value at the end of the lease term. So lower than the fair value that here they have the option to buy. Do you remember we discussed the example of the car? Okay, it's a finance lease that here now. Okay. Economic life of the asset is 7 years. Lease term is 6. The majority part is it is using by the. They say, but asset is not acquired at that. Not necessary to call it something as a finance lease. It should be acquired by the lessee. Not necessary. But the majority of part of the asset is going to be life of the asset is going to be used by the lessee. So it is also a finance lease. Then economic life of the asset is 6 years. The lease term is only 2 years. Okay. But the asset is special nature. We discussed about the example of ambulance. It is also finance lease. Present value of the minimum lease payment is equal to the fair value of the asset. So fair value of the asset is equal to the present value of the minimum lease payment. This is also a finance lease. Okay. Now this question number 32 is very, very, very important. What happened? I observed that whenever ICI asks the question here on accounting, most probably they're going to ask this type of question. Okay. Now question number 62. BNP Limited availed a lease from NNL Limited. The condition of the lease term are as under. What is the lease period? 3 years. At the beginning of the year 2020, the equipment costing rupees how much? 10 lakh. And the expected useful life is 5 years. The expected useful life is 5 years. And the lease term is 3 years. So we can say it's a finance lease from the age parameter. Okay. So if I say I will come to this point, but from the one parameter that here from the age point of view, that since substantially cover the major portion of the lease payment. No, not this second parameter. Okay, at the present value of the minimum lease substantially cover the initial fair value of the lease and the lease term. So out of 5 years, 3 years is going to be used by the lessee. So major part, so we can say it's a finance lease, but there are some other parameters that we have to calculate. We'll see that. They say what is the fair value of the asset here? Market value is 10 lakh. Now the cost is also 10 lakh, the fair value is 10 lakh. Okay. Then they say the property revert back to the lessor on the termination of the lease. Remember that it is not necessary to call it as a finance lease. It should be taken over by the lessee at the end of the life of the asset. Not necessary. Okay. The unguaranteed residual value is estimated rupees 1 lakh at the end of the year 22. They say the 3-year equal annual installment are made at the end of the each year. Consider IRR is 10%. So the present value of rupees 1 due at the end of the third year at 10% rate of interest is 0.7513. The present value of the annuity of rupees 1 due at the end of the third year at 10% IRR is rupees 2.4868. That is okay. Now understand what they ask you that here. They ask you state whether this is a finance lease or not. So what is unearned, we'll discuss it later. But whether it's a finance lease or not. So there are two parameters. First, we'll see whether the present value of minimum lease payment is substantially equal to the fair value, then we call it the present value. So we have to find it out. We call it the finance lease. So we have to find it out how much is the present value of the minimum lease payment. But how we can find it out? This is first of all, it is not mentioned in the question that now about annual lease rental that here. If they mention the annual lease rental, we just calculate the present value and we can find it out the present value of the minimum lease payment. But annual lease rental amount is not mentioned. How we can find it out? So what it says that what is the, you know that unguaranteed residual value is not a part of it. Here in the minimum lease payment, unguaranteed residual value does not cover here. In the minimum lease payment that here, unguaranteed residual value that here, it does not cover that here. Unguaranteed residual value that here, it does not cover here, okay? In a minimum lease payment. So what happened that here now? How to find it out then? So first, let's talk about how much is the unguaranteed present value of the unguaranteed residual value. The total amount of the unguaranteed residual value which is given 1 lakh, and there it is going to be realized at the end of the third year. So their discounting factor is 0.7513 which is given. So present value of the unguaranteed residual value is 75,130. So if I say that here of the unguaranteed residual, if I say that here present value of the lease payment. So what is the present of the lease payment? Because in the lease payment, it does not cover the unguaranteed residual value. Okay. The total amount is how much is the fair value? 10 lakh. If I remove the 75,130, which is the present value of the minimum, present value of the unguaranteed residual value. So this is the present value, present value is coming of the lease payment. Why? We have not considered the present value of the unguaranteed residual value because unguaranteed residual value is not the part of the lease payment. Okay, that's why we have deducted that amount. So this is the total present value of the lease payment. Now, can we find the annual rent? Yes. That is coming at 9,24,870 that here now. If I say that, first of all, 9,24,875. If I say how much is the total value of the asset? 10 lakh. So fair value is a 10 lakh. So if I say the fair value is 10 lakh that here, which is given in the question, and how much is the present value of the lease payment is 9,24,870. So we can say it is covering 92%, so more than 90, or it is substantially equal to the fair value that year. So what is going to happen? We will call them as the finances. This is a unique question that year, but I say repeatedly they ask this question that now. Okay, so understand what they have done that now. To find it out the lease payment, they have deduct the amount of the present value of the unguaranteed residual value. We are calculating the amount today. Unguaranteed residual value is going to receive after 3 years. So we calculate the present value. We deducted the amount, so we find it out these value that here. Okay. Now this is the present value of the lease payment. How much is the total fair value? 10 lakhs. So how much percentage is represent? 92%. So if it is more than 90%, we can say substantially. So that here now. Here, if I will come to the other part as well. That is now, since it is substantially cover the major portion of the lease payment, the lease constitutes a finance lease. Second is the parameter 2, as the present value of the minimum lease payment substantially cover the initial fair value of the lease asset. Okay, and the asset term is 3 years, while the cover the major part of the life of the asset. Therefore, it's considered finance lease. Therefore, we have to call it finance lease. Now, certain time they may ask you to calculate the annual lease rental also. This 9,24,000 that here now is 870. This is for the 3-year lease payment that here. Okay. Now these divided by this is the present value of the lease payment. Okay. Remember, this is the present value of the lease payment. Divided the present value of these 3 years, the discounting factor 2.4868 which is given. This is the annual lease rental will come. When you multiply by 3, so it is the total lease payment. Here if it multiply by the 3, the total lease payment will come, and when you deduct the present value from them, so unearned finance income will come. Now understand that this is annual lease rental multiply by the 3 years. This is the amount that here. Okay, now if I want to calculate the unguaranteed residual, we found the interest income as well that here. So first of all, under the lease payment that here, now what does not cover? The unguaranteed residual value. So we have to add the unguaranteed residual value. So we are going to receive total this much amount that here. Okay. Now if I want to find it unearned finance income, so I calculate the minimum lease payment, then I add the unguaranteed residual value, total amount. Then we are going to deduct the finance income. So in net investment will come. Or if we deduct the net investment from the gross investment, finance income will come automatically. So what we have done that now, this is the gross investment. Now the net income, that is the present value of this. If you calculate the present value of this amount is this, present value of this is this amount. So if we take the present value, okay, if you see that here now, the present value of gross investment is nothing but here, just remember that, okay, net is present value of this here, present value is that here of these here if we talk about a gross investment, if you take the present value, net investment nothing but the present value of the gross investment beta. The present value of the minimum lease payment, the present value of unguaranteed residual value is the net investment. So if you deduct this here, that is coming 10 lakh, coincidence that now. So this is the unearned finance income that here. Okay, simple. This is how they calculate that here. Okay, so you just have to do the practice of this question. So many times they ask this question. Okay, now come to question number 63. They say a machinery was given on 3 years operating lease by the dealer of the machine for equal annual lease rental, yielding 30% profit margin on cost of rupees 1,50,000. Economic life of the asset, a machine is 5 years. An output from the machine are estimated 40,000, 50,000, 60,000, 80 and 70. So they have given the output for the 3 years, but they are taking the on lease for 3 years only. The life is 5 years, but we are taking on the lease for the 3 years. So now straight line depreciation in proportion to the output is considered appropriate. Now compute the following that here. Annual lease rental that here. Okay, so they ask you annual lease rental. Simple. First of all, what is the cost? 1,50,000. Do your own calci. 1,50,000. Now plus 30%, they want to make a profit. So plus 30%. So what is the total lease? 1,95,000. So 1,95,000, I will say that here now. Okay, 1,95,000 divided by the total output. Total output, if you see that now, 40 plus 50, 90 plus 60, 150 plus 80, 230 plus 70, 300. So divided by 300. Okay, if when you say divided by the 300 not here. Okay, or multiply annual lease rental. Okay, first annual they ask you, so divided by just for the 3 years. 3 years. So divided by 3 when I do, it is coming how much here? Just 1 minute. 1,95,000 divided by 3. That is coming how much here? Is the 32,500 is the annual lease rental that here. Okay, so you can 32,500 that here. Okay, then they say that here now is the just give me a minute. What they have done that here? Okay, they have just done the calculation 130 divided by. Okay, just give me a minute. 1,95,000, 1,50,000 plus here is the 30%, 1,95,000 that here now. Okay. Just give me a minute. I think we have done some mistake that here. Okay, just give me a minute. Okay, the total annual lease rental, just let me calculate again. 1,50,000 plus 30%. Okay, then here 1 lakh. Let me calculate here again. 1,50,000 plus 30%. Okay, now this is the, now go to the formula that here now. Okay, now here they say that here now is here annual lease rental. Okay, as per the information given in the question that. Okay, no, here they say now the total lease rental. So total lease rental is going to come 195 divided by total. Yes, total output. How much is the total output here? Is the 300 that here. Okay, is the 300 is the total output that here. And they say how much is the output of the respective period. So we are calculating it for the 3 years that we say, because they have given the lease for the 3 years. So that is for the 3 years it is coming 40 plus 50, 90 plus 60, that is coming 150. That is coming 150. So here it will come 1,50,000 plus 30% divided by 300 multiplied by 150. That is coming in 97,500. Okay, this is the lease rental for the this is lease rental that we calculated for the 3 years. Now annual, if I say divided by 3 years, now this is correct. 3 years, so divided by 3, that is coming 32,500. Okay, this is correct. Okay, what happened? Now understand what is the correct treatment. 300,000 is the total output, but we are taking for the 3 years only now. So that for the 3 years it is coming 150. So basically the lease rental will come 97,500 for the 3 years. So how much will be for the 1 year? 32,500. Now they say the lease rent income to be recognized in each operating in the proportion of their output that here. So this 97,500 divided by 150 that here multiply by 4. These are total lease rental, but how much to be recognized in the proportion of their output. The first year output is 40, second year 50, and third year what is the 60. So 97,500 divided by total output for the 3 years multiply by first year output. Then for the second year same, third year. So this much is the they are going to recognize it. Then they said how much should be the depreciation for the 3 years of the lease. The lessor is going to charge the depreciation for how many years? They didn't say 3 years. Or depreciation for 3 years. Okay. So for 3 years that year, in the proportion of their output, the lessor will charge the depreciation that year. This is seeing the depreciation is proportional to output is considered appropriate. The depreciation amount rupees 1,50,000 because the cost of the asset is 1,50,000 beta. The 30% is the amount, is the profit percentage. So they are going to recognize the depreciation on the cost only. Okay. So 1,50,000 divided by the total. If you do the output of the 3 years, multiply by the year, 5 years, that is 300. Multiply by the first year, then second year, then the third year. Okay. This depreciation is going to be charged by the lessor. Okay. This depreciation is going to be charged by the lessor. This is operating the lease because. Okay. Now we will come to the concept of that here, the last concept, the sale and the lease back. Now we'll discuss what is sale and lease back. Now what is sale and the lease back? What happens? Suppose there is a Mr. A. okay, this is Mr. A, who sell the asset to someone and they get it back in the form of lease. So he is basically doing sale and leaseback. The sale and leaseback, he is a lessee is doing. Why I am calling it lessee? He sell the asset. Okay, he sell the asset that here now, and he get it back that year. So he is the lessor because he is giving the asset, okay, in the form of lease, and he is the lessee. So AS 19 talks about how to do the accounting, the person who is doing sale and leaseback. So they are talking about from the lessee's point of view that, okay. As it is just a revision lecture that is, I will just tell you that how to do the accounting of that here, okay. But in regular batch that I explain in so much of detail all these concept and all that, what is the logic behind it, that is all I do in the regular batch, okay. But understand that how to do the accounting of the sale and lease back. First, we have to see whether it's a finance lease or the operating lease. If it is a finance lease, just one thing is that here, when you get back the asset that here, when you sell that, because we are passing the entry of the sales here. So when you give on the sell the asset that here, you have to pass the entry, bank account will be debited, like the 20,000, and the book value of the asset, suppose that is just 1,000, and we cannot credit to P&L account, it will be deferred that. This is the main intention, because someone, suppose I am giving an asset, I will take it back in the form of lease from you. So I will use the asset, the same asset, but I may recognize the profit in my books of account by manipulating it. Suppose the book value is 1, I am selling you at 20. So the profit will appear in my books of account and I will get the asset same also at the same time. So they say no, it is not allowed. It has to be deferred here. But they say the profit or loss on sale should be deferred. This is what we have done. And write off in the ratio of depreciation. So because because it's a finance lease that year, that will be recorded in my books of account as an asset that year. So in the proportion I am charging the depreciation, in the same proportion the balance of deferred, these will also be transferred to the P&L account. Okay, remember this. Now, if it is the operating lease, three situations might be happen. The sale value is equal to fair value. It means there is nothing wrong in that. They are selling the asset at the fair value in the market. Their intention is not to manipulate the thing. So you can immediately transfer the profit to the P&L account. So bank account will be debited. Asset, we are selling the asset, then we'll lease back. So when you're taking a lease back, it is an operating lease. So we are talking about when we sell the asset. The bank account will be debited, P&L asset account will be credited, and immediately you can credit to P&L account. There is nothing wrong in that, because the sale value, nothing wrong in that. Because sale value is equal to fair value, we are whatever is the fair value in the market, we are selling the asset at the same price. So our intention is not to manipulate the thing. But if suppose the fair value, suppose let's say the 45, I'm selling at, let's say that 50. So this is the fair value and sale value, and suppose the book value of the asset is 30. Book value, not understand. The book value is 30, the fair value is 45, but I am selling at 50. So they say these profit, they understand it's a genuine, because the book value is 30, the market value is 45. They understand these profit 50. But you are selling more than the fair value, there's 45, 50, the difference is coming 5. So they say to this genuine profit, take it to P&L account, no problem. But this should be deferred that here, okay. So they say bank account will be debited, like in our example we receive 50, asset the book value is 30, okay, 30, and P&L account, that is the fair value minus the book value. The fair value is 45, the book value is 50, book value is 30, so here it will come the 15, and this 5 will come as deferred that here, that is sale value minus the fair value. So but what about these, the deferred? We cannot say that, like we have mentioned that here, in the proportion of depreciation, we'll transfer this deferred account also to P&L, because in the operating lease, we are not going to charge depreciation, so rental only we treated. So what is going to happen? The lessee will transfer in the P&L account in the proportion of rent. So they say defer excess of sale value over the fair value, amortize in rental proportion over the period for which asset is expected to be used. So it will transfer to the P&L in the proportion of what? The rental. Now, if the sale value is less than the fair value, okay, so here what, suppose the sale value is let's say that here sale value, suppose here is the 50, and the fair value is, suppose is coming 60. So what should we do that here? So they say here bank account should be debited. So I will say how much amount we receive, 60. So I will say 60 will be debited, not here, but here what is the, sorry, sale value is not 60, the sale value is how much? The 50. So sale value is 50. Assets, suppose whatever is the book value, suppose that the book value is coming, let's say that here now is suppose the book value is coming 60, suppose. So this 10 will be deferred here. So then the loss is compensated. It might be happening. Why we are selling the asset at loss that here now? at a less than the fair value. Suppose the fair value is 60, we are selling it 50 only that here. Why we are doing that here? Because our intention that here now to adjust the in later on that here, because I will be at, why should I sell at a loss that to you that here? Okay, so I will tell you I'm selling it at loss to you. You will give it to me later on. I will give you the lesser amount of the rent. The loss I will compensate in the form of rent later on. They say the loss is compensated by the future lease payment at the below market price, then defer it and amortize in the proportion of the lease payment. But otherwise, if it is a genuine, if suppose we want to shift to, we are in India, suppose we want to shift to like Dubai that here now. In a hurry, I want to sell the asset, but I sell the asset, but for the few period I want this asset, so I lease back from you that year. It's a genuine transaction that year. So might be I'm in a hurry to sell it less than the fair value. So in that, if it is genuine, then the loss can be taken to the profit and loss account. Okay. Now you have to see the situation accordingly. We have to give the treatment. I will go to question. Just one more concept. Let me discuss with you. We call it the manufacturer lessor. Certain time the lessor himself manufacture the asset, they sell the asset. But when they sell the asset, if the payment is going to be done by over a longer period of time, there is an interest component in that. So they say selling profit. Suppose if I say that here is the sale value. Suppose that here normally when I sell the asset that here now is the cash price, we call them, is 20, and suppose the cost is 60. This profit is genuine. Immediately I will recognize to P&L. But you are not going to pay me right now. You will pay me after in a period of 5 years. I will say no price to you, that is selling price to you, in your case it will be 30. The cost is 16, and how much will come? 40. So these profit, they say 4 will take it to the P&L, but this 10 is in what are the finance income that year, because you are delaying the payment that, that's why the profit over a genuine profit will be considered interest income that. Okay. So this is selling profit. This is a selling profit. This is a selling profit. This selling profit will be recognized immediately in P&L account, and this finance income recognized over the lease term that here. So they say, okay, this issue L should become lease term that. Okay. Selling price. Okay. Selling profit is what? Sales minus cost. What is sales? They say sales is lower of fair value and present value of minimum lease payment, and cost is the cost of goods minus present value of unguaranteed residual value. Why they have deducted unguaranteed residual value? The logic is that here, when we talk about the sales price, this is the fair value or the present value of minimum lease payment. So minimum lease payment does not cover the unguaranteed residual value. So on sales side, there is no unguaranteed residual value. So they say on the relevant expense, they also say that here. So they say from the cost of sale also, they say reduce the present value of the unguaranteed residual to keep it, to keep the base should be the same. So anyways, remember these formulas that here now, but generally a question not comes on these part. The question might come that here now, here is sale and leaseback in the examination, or from the accounting, or the question number that I mentioned to you. This question number is very important, is the question number 62. This question is very important. Okay, now I'm coming to the last question that here now. Okay, now understand, we'll discuss here only. A Limited sold machinery having WDV, how much? What is the WDV? The book value. WDV means the book value is 40. And to be limited for rupees 50 lakh, but they are selling at what price? They are selling at what? The 40 lakh. So book value is 40 lakh, but they are selling at 50 lakh that year. And same machinery was lease back. It's a case of sale and lease back. And it is specifically mentioned it's operating lease. So they are talking about this. They are talking about these here. Okay, they are talking about this sale and what here? The lease back. These we have to find a situation and accordingly we will discuss the accounting treatment. So they say the selling price is how much? 50, which is equal to the fair value. This is sales price and the fair value is equal. No problem. Sale price and the fair value is equal. Whole profit will transfer to P&L. So they say the profit of 10 will be transferred to the P&L. Okay. Then they say that here now fair value is 45. Okay, I will come to it later that here. First come to this point number here. C. They say fair value is 40 and the selling price is 50. Now the book value is 40. The fair value is also 40, and they sell at 50. So basically here this is the situation that here. This is a situation. Okay. So here they say book value is 40, fair value is also 40. So nothing is going to transfer to P&L. Complete 10 will be transferred to the deferred. So you can see that here 10 will be deferred that here. Now they say in point number D, fair value is 46. So book value is 40, fair value is 46, and this 50 is what? The sale value that here. So this will go to P&L, and this will go, how much is coming? 6 will go to P&L. Here difference is coming for, that will be deferred. So you can see the 6 will go to P&L, 4 will be the deferred that here. Okay. Now here
The point number B is that here they say fair value is 45 and selling price is 30. They are selling the sale price below the fair value. So what is going to happen that but the book value is 40. So 40 is the book value. They are selling at 38. So 2 is going to be a P&L account if it is not going to be compensated in the future that year. Okay, if it is going to be compensated in the form of rent in the future, then it will be the deferred that year. Okay, so this is all about accounting standard 19 from the examination point of view. These sale and lease back, these chart is important that year, beta. And remember, this here is this is important, and these the question that I have covered in the class, question number 62, that is important, and this accounting treatment. Okay, so that is for today. Take care all of you. Bye bye.